Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. And, well, let's just say the Marcus Corporation's latest financial report has some interesting things to share that might make you rethink your popcorn budget. In today's video, we are diving deep into the Marcus Corporation's quarterly report, looking beyond the numbers to see what they really mean for the company's future. Grab your snacks because this is going to be a ride. And if you love getting straightforward insights from these filings, make sure you are subscribed. We also have a Discord community linked in the description below, where we break down more of these financial documents. So, what are we looking at here? This is the Marcus Corporation's quarterly report for the period ending the 30th of September 2025. Think of it as a progress report on how their movie theaters and hotels are doing. Let's peek at the balance sheets. This tells us what the company owns and what it owes. In simple terms, their assets are generally decreasing, going from over $1 billion at the end of 2024 to just over $1 billion in September 2025. That might sound like a lot, but it is a slight dip. Liabilities, what they owe, also decreased a bit, which is generally a good sign as it means they are paying off their debts. Now for the really juicy part, the income statements for the 3 months ending the 30th of September 2025, they reported a net earning of about $16.2 million. That sounds pretty solid, but when we look at the 9 months that ended on the same date, the picture changes quite a bit. They reported a net earning of only $6.7 million. This tells us that the most recent quarter, the third one, was much better for them than the first 9 months combined. This also shows up in their earnings per S-share. For the 3 months, common stockholders earned about 53 cents per S-share, and for the 9 months, it was only 22 cents. This highlights that the most recent 3 months were much more profitable compared to the first 2 quarters of the year. When we look at comprehensive earnings, which includes certain other income and losses not on the main income statement, it paints a similar picture. For the 3 months, they had a positive comprehensive earning of over $16 million, but for the 9 months, it was about $6.7 million. Again, the third quarter was a strong performer. Now let's talk about cash flow, because that is what really keeps a business alive. For the 9 months of 2025, they brought in about $35.4 million from their operations. That sounds good, but it is actually less than the $51.4 million they brought in during the same period in 2024. So, while they are still making money from their core business, they are bringing in less cash from it than they were last year. This is a key point to watch. They are also spending money on their properties. For the first 9 months of 2025, they spent nearly $61 million on capital expenditures, which is more than the roughly $54 million they spent in the same period of 2024. This means they are investing more in their theaters and hotels, which could be good for future growth, but it also means less cash is available for other things. Looking at their debt, it is a mixed bag. Their total debt, after accounting for things like debt issuance costs, was about $162 million as of September 2025, which is a slight increase from the end of 2024. This isn't alarmingly high for a company their size, but it is worth noting. Here is where things get interesting. Their net leverage ratio, which essentially tells us how much debt they have compared to their earnings before certain items are removed, stood at 1.69x in September 2025. While this isn't terrible, it has increased from 1.28x at the end of 2024. This means they have taken on more debt relative to their earnings performance. This is a critical metric for investors to watch. Let's talk about the businesses themselves. Their overall revenues for the third quarter of 2025 showed a decrease compared to 2024, about a 9.7% drop. This is mainly because their theater business brought in less money. However, for the first 9 months of 2025, their revenues actually increased slightly compared to 2024. This suggests that while the most recent quarter was a bit weaker, the year as a whole has seen some growth. Digging into the theater business, revenues dropped significantly in the third quarter of 2025. They blame this on fewer blockbuster movies with broad appeal and a less favourable film mix compared to the previous year. It is like saying the movie selection just wasn't as exciting this quarter. They did mention some strategic pricing changes helped, but it wasn't enough to offset the weaker movie slate. For the first 9 months, theatre revenues did increase, but they still underperformed the overall industry growth. Their admission revenues, which is basically ticket sales, saw a notable drop in the third quarter. For the first 9 months, it also grew, but not as much as the industry. This means they are grabbing a smaller slice of the ticket sales pie compared to other movie theaters. Now, concessions are usually a bright spot. Their concession revenues, which are those delicious and profitable snacks, increased in both the third quarter and the first 9 months of 2025. This is good news, as concessions often have higher profit margins than ticket sales. People might be buying fewer tickets, but they are still spending on popcorn and candy. Moving over to their hotels and resorts, revenues actually increased slightly in the third quarter of 2025 and also for the first 9 months. This is a positive sign, especially considering the theatre division's struggles. However, their operating income for hotels decreased in both periods. This means that while they are making more money from sales, their costs are also going up, eating into their profits. Some of this is due to increased depreciation from renovations. Occupancy rates for their hotels went up in the third quarter, which is great, but their average daily room rate, or ADTAR, actually went down. This means more rooms were filled, but at a lower price point. This is why their revenue per available room, or RevPAR, showed a slight decrease. It is like filling more seats, but at a cheaper ticket price. Looking at their overall financial health metrics, the Marcus Corporation's net debt to adjusted EBITDA, a key measure of how easily they can pay off their debts, increased. This means their debt burden has gone up relative to their operational earnings. It is not a crisis, but it is a trend to watch. Their total adjusted EBITDA, which is a measure of their earnings before certain expenses, decreased in the third quarter of 2025 compared to 2024. This is largely due to the weaker performance in their theatre division, even though their hotel division saw a slight increase. Corporate costs also went up, impacting the overall picture. For the first 9 months, their total adjusted EBITDA also declined. So what is the story here? The Marcus Corporation is facing a bit of a mixed bag. Their theatre business is struggling with fewer appealing movies and increased competition, leading to lower revenues and earnings in the most recent quarter. Their hotel business is showing some resilience with revenue growth, but profit margins are being squeezed. The company is also taking on more debt relative to its earnings, and its operational cash generation from its core businesses has decreased. On the positive side, they are investing in their properties with increased capital expenditures. The concession business in theatres is still performing well, and the hotel division is showing revenue growth even if profitability is a challenge. The company's leadership seems aware of the issues, particularly with the film slate impacting theatres, and they are making strategic pricing adjustments. However, the increasing net leverage and the reliance on blockbuster movies for theatre success present significant risks. The hotel business needs to find a way to increase profitability despite rising costs and a softening average daily room rate. For the Marcus Corporation, the path forward seems to involve navigating a challenging film release environment while trying to boost profitability in their hotel segment. They need to carefully manage their debt and find ways to generate more cash from their operations. The increased investment in their properties might pay off in the long run, but investors will be watching closely to see if it translates into stronger financial results. It looks like they've got their work cut out for them, especially in the theatre division. That is our breakdown of the Marcus Corporation's latest filing. What do you think about these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.